Let's talk about what the market setup is looking like, what could be the actively traded stocks, and what could not. Hemang Jani joins in at the show right now. Hemang, hi, morning. Good to have you on the show as always. Help us understand how you're analyzing BOB's performance. And many in the market believe that with this quarter, NIMs for banks should be peaking out. Would that be a concern, you think?
Good morning, Aisha. I think BOB numbers were operationally in line, and we feel that overall PSU banks as a space has done pretty well operationally. And though there were in between concerns about this expected loss provision, we think that it is a little too early to really react to that. So I think when you see a strong earnings growth, let's say at pre-provisioning level, the growth is almost about 43%. Asset quality has improved. And when you look at the other parameters like return on assets, etc., there is a significant improvement. So I definitely think that the earnings cycle is still very strong. And though we can always debate about the NIMs, having peaked out, but as long as you see strong earnings growth and the valuation comfort with ROA, I don't think we need to be negative on the sector per se. So we continue to be very positive on BOB.
Okay, let's get a move on then and find out what the stocks are on the editor's radar today. Let's begin by discussing diagnostic stocks then. And it's interesting because we've mapped out the data when it comes to the valuations as well as the revenue growth pre-COVID, as well as what they are at the peak levels and currently. And Nikunj, what's the diagnosis?
No, I guess the prescription was not looking great.
Oh.
But I think now things have started improving for an investor. See, this is how things really moved for the entire diagnostic space. In the green is pre-COVID. Then you had the impact during the COVID peak, and now what the current market valuations are. So if you frankly ask me, some of the valuations for some of the diagnostic stocks, they'd become sky high in COVID.
During COVID, yeah.
They reached to P multiples of 100 times, 70 times. And that is not going to be sustaining for a business which is growing at about 10 to 12% to 12 to 15% depending on the company you're talking about. So there was an extreme greed and a euphoria during the COVID time. But after that, there's the realization which has kicked in that, look, these are not extraordinary businesses. They went through an extraordinary, they enjoyed an extraordinary tailwind. But these businesses now, these companies are still growing. The need for better healthcare, the need for early diagnostics, this entire market is gaining, the listed players are gaining more market share. There's a massive consolidation which has already happened in the industry. So from euphoria to now fear, I guess now it's time to start buying into some of these diagnostic stocks. They generate a lot of cash. These are high return ratio companies. Markets have completely written them off. They have presence in the F&O market. They are using technology and AI. We are forgetting that how technology and productivity in some of these functions is actually improving. So I will not be surprised that after this real massive decline, what some of these stocks have seen, Metropolis is down 25% from its 52-week high, Dr. Lal is down, it's actually flat, but from the top it's down by about 50%. Some of these stocks can actually give you a positive returns or a double-digit returns from here to, let's say, year end.
Okay, that's the prescription on the diagnostic stocks, but let's shift gears and talk about IOC in particular, a result candidate, and interesting because their quarterly profit came in at a 10-year high, and even analysts believe that some of the issues when it comes to are looking pretty transitory in nature, and there's been a beat led by refining.
I guess the refining margins have surprised everybody, and the fact that refining margins have gone up by $2.4 and they are at $7.1 for a quarter gone by, I think was extraordinary. Two things which I think are happening now. One, the windfall tax which was there on diesel exports, that's over, which means government is okay if these companies are making money via exports and by refining. Second, at the retail level, oil marketing companies are now making money. We spoke to the chairman of HPCL. He did say that, look, it's looking good for us. And looking at the fact that this time around, even before Karnataka election, the fuel rates were not down. That means that the government is committed to really help these companies make money. Unlike last year where they were arm twisted or they were forced not to take a price hike because government had to bring inflation down, this time around fuel prices are down or crude prices are down, rupee is stable, yet there is no price cut, which means on a retail level, when they're selling diesel, petrol, both industrial and retail, they're making money. So GRMs are strong, stocks have underperformed, currency is stable, crude is down, and then they're making money in the marketing margins, which is the basic bread and butter business for them. It's an ignored sector. Avan, FIs don't buy this, but domestic institutional investors, I think it's a matter of time, will take notice of the fact that there is deep value in these stocks.
And IOC already delivering on that front. So Aisha, interesting take there with stocks on the editor's radar.
Oh yeah, absolutely. In fact, let's add one more, and that came out with its numbers, Bharti. Hemang, you have a view here, right, on the reduction in the free cash flows despite the 27% jump in EBITDA that they've actually posted in this particular quarter. What does it really spell for how the stock is going to pan out from here?
Yeah, so Bharti numbers we feel were quite okay. The revenue growth was in line, barely about 1% growth. But the big concern that we see is that there is a significant decline in the free cash flow, almost about 7 billion from 48 billion that they reported 3 to 4 quarters back. The capex is really, growing too aggressively. So my take is that, unless you see a significant improvement in the ARPU, which looks unlikely, the stock can actually go through a correction of about 8 to 10%. Given that it has remained quite stable for many months now. So we do expect some negative reaction on Bharti post these numbers.
Okay, that's the take coming in on Bharti. Yesterday, you saw a bit of a traction really in a couple of the mid-cap IT names, led, of course, by Birlasoft after its earnings. 6% higher is where that stock shut shop. Hemang, recommending at all to start nibbling in at least within IT, maybe mid-caps only?
Yes, surely. I think mid-caps have done much better when it comes to the, this quarter. And even when we look at the stock prices, they are doing much better than some of the large cap names. So I think within the mid-cap universe, we like Cyient, which reported almost about 7 to 8% kind of a quarter-on-quarter growth. Apart from that, we think that, Persistent also a very decent set of numbers. And Zensar, which is a very small cap company, again, the revenue growth was not that good, but, big positive surprise on the margin front and outlook front. So we do think that the mid-cap IT is the space where you will see a good traction. Even if we see a little bit of correction or consolidation, some of these names can present a good opportunity to enter with a, 15-20% kind of an upside.
Okay. Just scanning through lots of stocks, and one breakout stock yesterday was Mazgaon Shipyard or Mazgaon Dock. Just when we thought that the defense stocks are losing their mojo, Mazgaon Dockyard just comes back and goes up 7% higher yesterday.
So a lot of these names only went through a sideways correction, a little bit of a dip, and then were consolidating for quite some time. And we are seeing the next leg of the move play out. We saw a correction from 950 odd levels in Mazgaon to 650. It was a slower drift compared to the fact that it had gone up almost 3x from 300 levels. Now, yesterday, and the more interesting part is not just the price action, but the volumes are almost 5 to 7x the normal volumes. So the recovery from 650 to 800 last time was on lower volumes. This is the first indication of sharp volumes. And we are seeing this across the board. So a GRSE is another one which looks interesting. That stock has gone through a nice sideways consolidation. 540 is a resistance. It's been a range of 410 to 540. That's a stock that can break out in this segment. And then we are seeing that, say, Bharat Electronics has finally come back to 108. The all-time highs are 110 to 115. Bharat Dynamics is on verge of a breakout into new 52-week highs. Yesterday, HL made a new 52-week high. So clearly, defense continues to be a sector which looks interesting, more so from the PSE side. Even smaller names are doing well, whether it is Avantel, Zen Technologies, or Dynamatic Tech. So the sector still is in a strong hands. And we are seeing this across the board in defense names, whether it is large cap or micro caps.
Defense, that continues to be a running theme. In fact, this at a time when mutual funds as well are launching specific defense-focused portfolios as well. Hemang, opportunity to buy a fresh share considering this is a long-haul story.
Yeah, I do think so. Apart from the fact that the numbers have been good and the government is going too aggressive in terms of, giving out orders, some of these names do get included in the MSCI, small cap indices. And because of the, small cap nature and the liquidity issues, sometimes this kind of flows can also have a bigger impact on the prices. So we do think that HAL, Bharat Electronics, Bharat Dynamics, I think these are some of the names where you can expect, a good momentum, 10-15% kind of an opportunity. The only thing is that sometimes it goes out of flavor. So, one should try to really time it with some technicals so that you can really take advantage of the opportunity.
Right. Okay, let's just pause here and let's get you some more fundamental stock ideas. Here's Pankaj Pandey and Deepan Mehta telling us what they recommend buying in this market.
Darren, US revenues were a beat compared to our estimates. Even last quarter, revenue growth for US was quite good. I think India business is yet to sort of pick up, but while Europe is sort of also done well. But our sense is that the company has been focusing more on domestic business, which is contributing about high single-digit kind of a contribution to top line. And going forward with the perspective that domestic business will contribute more and which is a relatively less volatile business, our sense is that Dr. Reddy going forward should ideally do well. We had a previously buy rating. I think we'll again sort of review the numbers, and largely our sense is that things remain intact in terms of what our thought process is. So we'll continue to maintain a positive stance on that company. I think on Sanofi, the challenge with Sanofi is that their growth numbers are quite muted. I mean, 3-4% kind of a growth is quite muted, and even the demerger also may not really do much because when you look at some of their top brands, so those are still sort of giving a flattish or a negative kind of a growth. So from that perspective, unless the growth does not revive, I think demerger may not really help much. We had a previously hold rating on the stock. I don't think, given the numbers, we would need to sort of change the stance there.
I think Cummins is in a very interesting space. We have been very positive on the entire engineering capital goods space. And Cummins, I think, is one of the leading engineering companies. I think it's gensets and diesel engines. Diesel gensets are absolutely world-class. And of course, they have the advantage of exporting to other Cummins subsidiaries as well on a transfer pricing basis. Valuations are reasonable compared to historically what the stock has traded at. And I think after many quarters of sideways to slightly disappointing performance, last 2 quarters, at least last quarter and this quarter, may be quite impressive. A lot of the cost increases, I think, have been passed on, and now we are seeing subdued raw material trends, and that should benefit the margin management for the company. And the way we are seeing infrastructure projects take off, I think there's going to be good demand for the company's projects or products as well. So very positive on Cummins per se, and it's a premium player, MNC company. And always has traded at a very high price to earnings multiple. So let's not get too impacted by that. But on the whole, I think next few quarters look very interesting and very positive for Cummins.
And there's one stock which has surprised everybody. It has surprised everybody. Naresh, you want to guess which is one stock which has surprised everybody and which stock I'll flag off for you? It's a pharma stock. Take a guess.
Tough one.
Very easy one. Aurobindo Pharma. From 380 it has become almost 650. 300 rupees. 300 rupees for a stock in less than 3 months. It's almost like a 50% hike.
So the stock has the tendency to only surprise on both the sides. So it's one of the stocks that is tough to trade. It had this one great cycle in 2013 to 2014-15. Post that, the moves have been crazy every time. So if we go back to COVID, the low was closer to 280, 340 levels. It went back to 1050. And cut to, say, 2 months back, we were back to 400 levels. So there was more than a 60% fall. and now we've seen a recovery of almost 50-60%. So the stock has this tendency. Apart from that, there are days when a single day the stock moves down 10%. So out there, this is a tough call, tough one to trade. And that has been the case with pharma. Very recently, if you look at it, Dr. Reddy's gave a breakout. The stock moved up from 44.50 to 49.50 laboriously over 1.5 months. And all it took was 1.5 days to come back to 44.50 to 4500. So for now, this indicates pharma as a sector maybe bottoming out or say getting into a phase of consolidation, but it's a tough sector. It is no more a trending sector clearly.
Hemang, morning. What's your outlook when it comes to the entire real estate stocks? Because they really seem to be back in action. Do you believe that it's a very case-by-case story, or are you, sticking your neck out and you remain bullish on the entire theme owing to the capex growth, etc.?
So I think, this is a pocket which has done very well in the last, let's say, about 1.5 months, ever since there was a pause by RBI on the interest rates. When you look at the quarterly numbers, the outlook, it continues to be very strong. And our take is that this cycle could turn out to be very strong for next at least 2 to 3 years. And, this being a high beta space, sometimes the stocks go through big corrections, 30-40%. So I think even when they've gone up, let's say about 10-15%, we do see a scope for a significant, rally in these names. Godrej Property is something that we like. I think we can also look at Lodha, which kind of has relatively not done as much compared to some of the other real estate names. Even the new government in Karnataka, we think that, some of the names like Shobha, Brigade, they could do extremely well. So I think this sector is showing a lot of momentum and one should participate with a positive bias.
Okay. We are talking about one simple fact that markets have gone higher, but where is the participation? Indian mutual funds right now, Indian domestic mutual funds right now sitting at record cash levels. The record cash levels means that how much of the total percentage. Now that's the BHEL survey. We'll just come back to it. I just want to set context here. The Indian mutual funds right now are sitting on about 5.5% to 6% cash, which means the cash component in most of the mutual funds right now is up by about 60 bips, even though markets have gone higher. Now imagine if you're sitting on that much of cash, you will underperform when markets they go higher. On top of that, there is going to be additional inflows which will come into the markets this year, this month because of SIPs. So if Nifty keeps on going higher, then we could actually be looking at mutual funds cash levels at a relatively higher level. These cash levels of 5%, 6% were last seen during when the war broke out. And that was a very different kind of a geopolitical crisis. But the BHEL survey, which is a global survey of fund manager, very famous survey, which is done anonymously, where fund managers, they are encouraged to participate and talk about where they think markets are headed, what is in the price, what kind of cash levels they are in. 61% of the fund managers, the equity fund managers and bond fund managers, they feel that the Fed interest rate cycle has peaked out and the Fed may actually cut rates by 2024. That's what US markets are factoring in. Allocation to stocks is rising. It is at a 5-month high because if interest rates they come down, the allocation to stock will come out. Big rotation out of commodities into tech. Another very interesting. Now this global tech we're talking about, guys. We're not talking about Indian tech here. But the cash levels, according to BHEL survey, this is a global survey, the cash levels with some of the funds, I think has still not come down. Why am I bringing this cash level point out again? So that means that at a global level, if allocation is coming back into India, which it is, there's a lot of cash which will automatically come back into India because cash levels have to come down if markets rally. B, in domestic market also, cash levels are high. So markets go high, slip flows, they continue. Domestic institutional investors will be forced to buy. So there is a lot of gunpowder, so to speak, which is there, available with institutional investors to really participate even if markets they go higher. Hemang Jani, what is the status with HNI investors? I mean, do you think that they've participated in this rally or still there is a lot of left out syndrome?
So Nikunj, with retail investors and HNIs, I think the larger participation is in the broader market, which is mid-cap and small-cap category. And if you see last 1.5 months, we've seen a very strong up move there. And when we look at the cash volumes, there is a 25-30% kind of improvement that we have seen. And when you see the churn happen, when you see, let's say, a defense stock or some of the, pharma stocks, a very good listing by Mankind Pharma, so that lifts the sentiment up. So I think though there is a little bit of a, reluctance to enter because of the way the market is run up and the levels, I think given the momentum in the mid cap category, people are participating, and we think that this should continue. I don't see a reason why there is going to be a big correction in the market, or the broader market will correct in a big way, because results have been good. The interest rate cycle is turning a little better. Global markets, we are not seeing any major shock. So I think that's a good sign for retail participation.
Okay, that's the view coming in. Moving on then, Kunal, wanted to get in your take, and every time I open the email for the breakout shares, I see Birlasoft's name appearing on that list. Just what's going on? Because in the last 1 month, it's beefed up by nearly 25 to 30%. What's the outlook on the charts? And have you also had a look at Mazgaon Dock? Because that stock scaled up yesterday.
So I'll start off with Birlasoft. Interesting breakout, 4 consecutive weeks of uptrend for the stock. And I think after yesterday's up move, the stock has convincingly separated or diverged itself from its 200-day moving average. So for the prior 4-5 days, other than yesterday's breakout, the stock was just hanging around the 200-day moving average with a bit of an indecision that whether the stock would probably cave back again into a corrective phase or breakout. But I think after yesterday's move, one thing seems to be clear, that the stock is now starting to show signs of uptrend. Now, when you try and compare this with the previous 2021 highs for Birlasoft, the stock is at a significant discount. In the 2021 highs for Birlasoft was almost at 540, 550 levels, and currently the stock is at 320 plus, which means that even if the stock has to come back to those high levels, say in the next 1 or 2 years, the scope of uptrend could be significantly higher for the stock. So I think in that aspect, it could be a good candidate of a buy on dips. Now, on the other hand, Mazgaon Dock could be interesting because HAL is actually one of the prime stocks from the defense pack, which has actually given a breakout, I think almost 1 or 2 weeks back, followed by some consistency as well as some up move in BHEL. And now the move is trickling back into those mid-cap names back again. So it was not just Mazgaon Dock, which did pretty well yesterday. I think GRSC, Garden Reach Shipyards, Cochin Shipyard, many of these other names also started to show signs of a flat pattern as well as a minor swing pattern breakout. So I think it's got to do with the entire sector theme, that if the large cap or the more formidable peers from the defense pack, if they start to show signs of consistency of uptrend, breaking past about new highs regularly, then I think it could just be a matter of time that the mid cap and the defense pack could also get a bit more vibrant. So bullish on the entire defense pack. Specifically, HAL would be the top recommendation which I would keep on highlighting.
Okay, consistently bullish on HAL. Moving right on then, let's check in on those pre-open rates, and as of now it's a bit soft at 18,270 levels on the Nifty. For the Sensex 2, we're down about 93 points. Let's find out those mid-cap strategies then, and Naresh, what's your mid-cap bet?
So that would be a buy on Maharashtra Seamless. Now that's a stock which has finally made another move to life highs, or closer to that. It's very close to that levels. But if you look at the sector, the whole sector has been doing well. Whether it is Jindal Saw, Maharashtra Seamless, we are seeing this trend, Ratnamani Metals. So this is a stock which has made a new fresh 52-week high and an all-time high. The stock consolidated around this 430-40 resistance for the last 2 weeks, and now finally back well above the 440 mark. I would expect this trend to continue for the short term. Expect a move towards 500 to 530 levels. A stop loss to be placed at 425.
Okay, Maharashtra Seamless is what Naresh's bet is. What about you, Kunal?
So it's from the mid-cap cement pack. Sanghi Industries is a stock which I would suggest as a buy. Classical breakout on the monthly charts. A cup and handle breakout on the monthly line charts for Sanghi Industries. On the daily time frame, it's a flag pattern breakout after I think 3-4 days of consolidation for the stock. So again, interesting chart patterns, and that's why I would believe that the uptrend, both from the near term as well as from a medium term, could be intact. 85 as an immediate target for the stock, and stop loss at 70.
All right, let's get right back to the markets and all the khabar on D Street, where we understand that pharma major Glenmark Pharma is in focus. The management has returned after conducting roadshows in the US and across Europe. The company is also set to declare its Q4 earnings on the 19th of May. What exactly did the management guide at these roadshows? We've got Sharad who joins in with all the khabar. Sharad?
Well, yes, in focus we are having Glenmark Pharma, and over here important development coming in is that the management has recently come back from the US and the Europe's road shows for the investors, and they have stated that a strong growth guidance is expected for the margins going ahead, and also there will be a focus on the debt reduction. Now looking at the FY23 guidance numbers, the top line is expected to rise between 6 to 8%, while the margins are expected to be flat by almost 19%. The capex plans for the FY23 is expected to range between 700 to 800 crores. Now there are certain risks associated with the stock as well, and firstly the important thing is that the core US generic business has actually not picked up and is still under pressure, while there are important plants in Baddi and Monroe which are under import alerts. Now apart from this, also the Iconos portfolio and the licensing issue is something to ponder upon. While looking at the stock itself, the board meeting will be there for the earnings on the fourth quarter on May 19. Apart from this, recently the company announced formation of a new arm, Glenmark Healthcare, which will actually manufacture as well as come in trading of a pharma goods, and we spoke with industry participants and they stated that this move could actually aid margins going ahead, as well as cross-selling could be triggered. The stock itself, if you look at it over the last 1 month itself, is up more than 25%.
Okay, that's the view coming in on Glenmark. Thanks very much for that khabar. Hemang, before we let you go, tomorrow ITC will be coming out with its quarterly numbers. What do you think we can expect in terms of the performance?
So I think across all the divisions, there is a very good traction, be it hotels. We all know the occupancy levels and the way the companies are delivered. The paperboard, the cigarette business again is showing a lot of volume and price stability. So overall, continue to have positive bias on ITC, and though it has run up, I think the valuation when you compare it with FMCG is still very attractive. So should have a positive bias.
All right, there you have it, a positive bias there. That's ITC that we're talking about. And by the way, we're expecting revenues have about 7%. The cigarette volumes are seen at about 13 to 14%. Hemang, thanks so much for joining in. Good to have you on board.